All right, this video we're going to be talking about the ICT breaker block. Okay, it should be a very short video. Shouldn't take me very long to explain this at all. So yeah, let's talk about it. So I'm going to use this NASDAQ. This is an example that I called out on mic for my mentees a couple days ago. Just kind of eliminating the confusion here first. I solely trade Forex, but I also, for my mentees, I look at futures as well, because I do got some mentees that trade futures as well. So I look at futures and I break down the price action in there as well for my mentees that do trade futures. But personally, I stick with Forex. That's my bread and butter. That's what I like. But price is price. And let me make this clear as well, because some people, they always ask me, like, can I use it in crypto? Can I use it in stocks? Can I use ICT concepts in different markets? Yes, you can. Absolutely. Price is price. Has the same signatures. You can use it across a variety of markets. Okay, it doesn't matter what you trade, guys. Okay, here is what we saw on NASDAQ the other day. You can see right here, if you look at this 1 minute trend on NASDAQ, what do we see here? It's consistently trending lower. We can agree on that. See how it's just consistently making new lows in here? See how it's just printing red candle after red candle after red candle? Has a little retracement, makes a new low. Has a little retracement right here, makes a new low. What does that mean? Well, it means, in simplest terms, it's operating in a downtrend. It's operating in a very strong downtrend at the moment. And then right here, price moved up right here. It has yet again another retracement, and then it pops up to this imbalance. It finds resistance off that imbalance. It comes down and it attacks the low again, and it has the same pattern playing out. It has the same signature playing out. It's consistently putting in lower highs, and it's consistently making new lows. That's something that is operating. In a bearish market structure. Okay. And for the breaker block, number one, so pay very close attention. What you want to see for the best breaker blocks, I'm talking about the best of the best, right? The highest probability breaker blocks. You always want a higher time frame point of interest. Okay. You always want a higher time frame point of interest to have that reaction off of. So, and I'll explain what I mean when I say a reaction here in a moment. But what we're going to do first is we're going to zoom out. So we need a higher time frame point of interest. So here's the very first thing here. We identified this higher time frame point of interest the other day, me and my mentees, and it was this level right here. This is an established level of support right here. See this old high? So this was our point of interest that we had identified beforehand. Not only do we have that old high, which is serving as support right here, but we have an imbalance down below. Look right here. 1, 2, 3 candles. See how the top of this first one and the bottom of that third one, they don't touch. That leaves an imbalance. And these imbalances, whenever price comes down into them, it serves as support, because it's now efficiently delivered a portion of that price action. At the same time, you're testing old high support. And keep in mind, guys, this is on a higher time frame 4-hour chart. This is a higher time frame. So this is why I said it's a higher time frame point of interest. It's a higher time frame level that you're pressing down into. And now some of you, mainly the beginners, may be thinking, okay, well, hold up though. I'm a day trader. I'm a scalper. I execute on the 1 minute mic. I execute on the 5 minute mic. I ain't using no freaking 4-hour chart. That's what some of you are thinking. It doesn't matter if you're a day trader. It doesn't matter if you're a scalper. It's still useful to utilize the higher time frame chart. And that's an edge, because guess what? A lot of people, or a lot of inexperienced traders, they don't utilize the higher time frame chart. They don't utilize higher time frame points of interest, and they get chopped up in the lower time frame because they're not aware of these things that are occurring on the higher time frame chart. Big money, smart money, whatever the fuck you want to call them, they operate on the higher time frame chart. They have these higher time frame levels. So these are the levels that you want to pay attention to. These are the levels that you want to look for reactions off of. You can still execute on the 1 minute and the 5 minute, but whenever you have these reactions off of these higher time frame points of interest, much better, higher probability. And of course, if you could exercise enough patience to solely wait for reactions off of higher time frame points of interest, I mean, you can make a killing. You can make an absolute killing. But a lot of people, most people, don't have the patience for that. They got to be trading every single day. They got to be hitting every dang thing in the market, because they need that dopamine hit from gambling. And, well, quality setups, like super A plus quality setups, they don't happen that often. But when they do, be ready for them. So this is one of those scenarios where we have our higher time frame point of interest noted right here, and we have our inbounds noted right here, and we can see price on the lower time frame chart, as I was just talking about, it is consistently trending lower here. So if you're a short seller and you're focused solely on the lower time frame chart here, this thing looks so weak. Look at this thing. Look how it's just consistently trading lower. How it's consistently making new lows after new lows after new lows. This thing's getting demolished. It's going, the floor's just completely giving out on it. And then look right here. We're making a new low right here. It's making a new low. So we have a big bucket of short sellers who are getting in this. Okay, that are buying the breakout lower. They're looking for this trend continuation. You have existing shorts that are trailing their positions. And where are the shorts, guys? Where are they going to keep their stop at? They're going to keep their stop above resistance, which resistance is right here. So we make this new low. Okay, so this is your turtle soup right here. This is what we call as ICT. Again, another ICT term concept. It's a turtle soup. We have a move lower right here that sweeps the sell side liquidity, and it comes down into a higher time frame point of interest. And then that's when we see another move lower and then a ramp up. And it takes that high right there. It takes that resistance. It takes those buy stops. So here's the deal with the breaker block. The breaker block, what it will look like is you will have a fake move like this. You'll have a turtle soup like this. It'll look like it'll have a trend continuation to the downside like it's just been doing before. It's consistently moving lower, and it's consistently moving lower right here. But then guess what? It rejects. It just explodes higher, and it cracks that previous high. That's what you want to see. That's what you want to see. See that up close green candle right here? See that last up close candle right here? Before you had that move lower? This was the absolute top. This was the absolute top, the absolute price swing right before you took out that low. That's what you need to do. That's what you need to identify whenever you're finding your breaker blocks. You need to pay attention to that last price swing before it takes out the low. You need a specific signature. You need to see the price swing like this, put in. And then you need to see it make a new low. This is for a bullish breaker block. For a bearish breaker block, obviously you would just reverse it. It's the same exact thing. It's the same exact concept, same exact idea. It's just reversed. So it comes down and makes a new low after forming this high. It looks like it's going to have a trend continuation to the downside. There's your turtle soup. Boom. It rips up and it takes those stops. So the big bucket of shorts are now in the red. They're now down on their trade. Why? Because remember, they were looking for shorts. They were looking for a trend continuation to the downside. And now it's ripping up and it's taking this high. Of course, they're going to be red. It's going to be a red trade. Now it pulls back. And what does it test on that pullback? This right here, guys, is your breaker block. The old high is your breaker block. Boom. There's your entry. There's your entry right there. That is the breaker block. It puts in the high. It makes the turtle soup low. It has a reversal that cracks that high. And for the highest probability breaker blocks, on the break, you need to see a fair value gap. For the highest probability ones, of course, we got a fair value gap right there. See that? And that's what happens. It comes down. It pulls back into your breaker block, the old high. It comes down to the imbalance. And now you get a trend continuation. This reaction was off of a higher time frame point of interest. It was off of a higher time frame level. Those are going to be your highest probability plays. Those are going to be your highest probability breaker blocks. Okay? So whenever price returns to that point of interest down here, we have big shorts that are wanting to get out of their positions because they were incorrect, and now they want to position themselves and they want to ramp this thing up. That's what happens. Like, that's the idea behind the breaker block, because now it comes down to this. They get an opportunity to bail, okay, to cut their losses. And then look at that. It ramps up with aggression, with strength. And look at this thing. It just goes ballistic. That's the breaker block. So it'll look like a fake. It's basically a fake run. And then you'll have a reversal. And then you'll have a pullback into the old high. But you need this specific signature right here. You need the high put in, you need the low put in right shortly after, turtle soup. And then you want to see that rejection off of an established level of support that creates a surge up, aka your shift in market structure. That's what we call a shift in market structure, because now it's a change in trend. And then it comes down. The existing shorts can bail, and then they can, or the big shorts. Again, we're not really talking about retail shorts in this specific example, right? Because retail shorts can't move this thing up higher like this. That's big money. That's smart money. So they're able to get out of their position, and then they're able to send this higher after it returns to this point of interest and get positioned and capitalize on higher prices. So that is the breaker block, guys. About the simplest way I can make it. And again, for short examples, it's just the reverse of that. Okay. So have your higher time frame point of interest. Look for this specific signature right here. Look for the turtle soup into the higher time frame level. Look for the reversal. Look for the fair value gap. Then look for the pullback into the old high. And then there's your opportunity to get long. And then you can look for that move higher. It's a very simple pattern. And yep, I think that about covers it. So hopefully you guys enjoyed this review, and I will catch you later.